You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, I hope you made it through all the turkey and ham and stuffing, and we are back ready to talk about option strategies again. The marketplace has been a little volatile as of late, and the VIX being at 20 seems to be the new norm. So I got some great feedback over the Thanksgiving holiday about the trade that we did a few weeks ago in Apple. We talked a lot about the FANG stocks, and they're really showing their fangs recently to the downside. Facebook, Apple, Netflix, Amazon, Alphabet/Google. Those stocks have been just beaten up lately, and rightfully so. They've had a good run for the long time. So hopefully you were managing your portfolio and balancing it when you need to. But if not, we talked last week more about just stocks in general and going into the new year using the covered call strategy on stocks that you would not mind selling, either to get a capital gain to offset maybe a capital loss last year as far as tax purposes are concerned, or trying to make a capital loss, generate something to be able to help you out with your taxes going into 2019. Now, with all that said, we don't really discuss taxes on Options Playbook Radio. We're just talking about specific strategies for the time of the year. Nothing's ever meant to be a recommendation. We're just trying to learn here. So I'm going to go with that theme. We talked about doing a covered call in Apple. We looked at doing one just out of the money. We looked at doing one just in the money. We also talked about the collar strategy, just trying to get out to January of next year to maybe put off a capital gain on a stock that you're worried about. And I thought Apple was a great scenario there. And this week, we're going to take it one step further, and we're going to actually use buying options as a way to protect yourself on some potential capital gains, capital losses. What you want to do about it, you got to watch some wash sale rules if you'd like to. But once again, you're going to have to discern what your portfolio looks like as far as taxes are concerned. And we're going to look at that strategy. And we're really looking at using options as an alternative to owning stock or protecting a stock position. A great way to say this is options for the stock investor. And I think that all stock investors should have at least a playing card or two in their pocket for scenarios like we've had just recently happen in the FANG stocks, where they just been beat up down, some of them down 15, 20%, some of them down 5, 10%. But everybody in some way, shape, or form owns some of the FANGs. If you have a 401k, if you've just bought the stocks outright, but almost every single index out there has some form of the FANG stocks in that index, in that fund, in that exchange traded fund, that ETF or ETNs. All right, so with all that said, let's look at last week's trade or 2 weeks ago, I guess, that we talked in Apple. Apple was trading at 186.80 at the time. And I'm going to specifically look at the collar because I want to follow up on that trade because the market right now is very interesting relative to the collar that we put on 2 weeks ago. Now, I'm going to emphasize that we are taping Options Playbook Radio on a Wednesday. It is November 28th. The markets are closed, and Apple today was up quite a bit, but it still closed lower than where we were talking 2 weeks ago. It closed at 180.94, up $6.70. That's 180.94, up $6.70. Now, when we put on the trade, we put on a collar, and all we're doing was trying to protect ourselves, getting us to the new year. So here would be the concept. You've owned Apple for a while. It made the big run up towards 200, came collapsing all the way back down. It was at 186.80, and now you're nervous, but man, you got a capital gain. You don't want to take it in this year in 2018. Let's protect ourselves and see if we can get off to 2019. So that was the scenario. That was the picture we painted. The market was 186.80. We did a collar trade. We bought some protection, and then we sold a call to help pay for it. So the strike that we bought going out to January, it was 65 days away at that time. The date was January 18th, 2019. We bought the 180 put, and at the time that was trading for, we're going to call it around $6. And then we went and sold the 195 call. So we gave ourselves a little bit of upside, and we protect ourselves on the downside. And we actually were able to get that done for a net credit to the account of about a dime. And so a small net credit to the account. But all we're looking to do was sell an out-of-the-money call to help pay for our put protection. So our main goal was the 180 put. Now, the market has obviously came down below 180, considering that today it's up $6 and it's at 180. So now you have some choices. You're here. You were bullish but nervous on Apple, right? That's the best way to say it. We're bullish but nervous. We wanted to get out to the new year before we take any capital gains if we've had Apple since the beginning of the year or beyond that. And the market has gone down, and it's gone down quite a bit since that time. So with the market right now at 180.94, that makes our 180 put almost at the money. So the 180 put right now is trading on the bid for $6.95, on the ask for $7.10. So let's call it $7. So we have a 195 call. It's still out there. We'd love to see 195 at this stage, right? If it gets, we're just going to let that one ride. That's trading for about 275, right around that there at the midpoint. And we're going to let that hang because we still own the shares of stock. But what are we going to do with this put? The market has gone up on it. It's increased in value. We didn't pay anything for the collar. We actually brought in a dime credit. So now you have some options. You can obviously just let this ride because it's accomplishing what you would like it to accomplish. But if you are now bullish on Apple because it's had a big update today, you can just sell the put. So sell the put, bring in $7, and guess what? That basically matches the loss that you had since we put on the trade. Because remember, Apple was trading at 186.80 a week or 2 weeks ago after the market closed. That's where it was at. So interesting enough, it exactly would cover your loss that you had at that point in time. You'd still have the call on, you'd still have limited upside, but you could just sell that put and get out. Now, what's another alternative? Well, you can just roll it down. So we could look to sell to close the 180 put, take some of the money off the table, and then go and buy the 175. Now, I would stay in the same expiration because the whole goal was to get in to the 2019 year. But this is a very solid trade to do. You would sell to close the 180 and buy to open, let's say, the 175. In that scenario, that would be done for a $2 net credit to the account. And that $2 would just basically go right in your pocket. But now you'd have risk from 180 down to 175 is where you have additional risk because now you've moved down your insurance and you have a higher deductible. So instead of taking the stock, if it goes down to 155 and putting it to somebody at 180, you now would be able to take that stock and put it to them at 175. But you're going to take a couple of bucks off the table. And in this scenario, you're still going to keep yourself protected. So I thought where the stock was at, it made it an interesting conversation because, we were bullish but nervous and the market went down. What the best scenario, if you're ever doing any type of protective strategy, usually the best scenario is that the market goes up, right? If it would have went to 195, that looks pretty darn good right now. Go ahead and call my shares away from me. We'll be fine with that. But it didn't. It went down. Okay. So I'm going to do another form of protective strategies. Now, this does involve selling an underlying stock. So if you have a big run up in Facebook, some people still might have some gains out there, but Facebook has really been beaten up. Right now, Facebook, as of the close, once again on the 28th of November, we have it today at 136.76, up $1.76 today. That's 136.76, up $1.76 today. So here's what I would be looking at doing. Now, there are some tax rules that you need to be aware of, but Facebook has easily lost $25, $30, $40, depending on where you bought it at or where the underlying stock is at. So over the last year, the high on Facebook was 218.62 over the last year. Right now it's 136.76. So what we're going to do is replace shares of Facebook with an option as a surrogate for the actual stock. And Facebook is a very liquid stock, and that does benefit us in this scenario, but it also gives us protection. So let's say you've owned Facebook since it went public down around $25 a share, and it got all the way up to 218 and you never got out and you thought, oh man, what did I do? I should have sold it. And you just keep around. You say, well, it gets down to 175 and you say, okay, when it gets to 200, I'll sell. Then it gets to 150 and you say, well, if it gets to 175, I promise I will sell. And now it's at 136. And a lot of that expansive capital gain that you had has been beaten up, and now you might even, some people out there might have got bitten and actually are down on the position because they bought it closer to the high. So what's an alternative that you can do that you can protect yourself in this scenario on a 100-point loss? Or you could even think to yourself, well, maybe when it was at its highs, this was an alternative that I could have done. And so I guess the theme going into the new year is protection strategies. So here's what we're going to do. We're going to go on out and we're going to sell our shares of Facebook. Now that could create a capital gain in your account, but it could also be a capital loss, obviously, depending on your cost basis in Facebook. And we're going to replace it with a deep in the money call option. And we're going to look at something that's about an 80 delta. That means it's going to act like 80 shares of stock. The stock goes up one, your option should move up about 80 cents. And in this scenario, I just want to get out into the new year. I'm a little bit nervous about what's happening in the new year, and I'm going to go out to a March 15th expiration date. on this. The March 15th expiration, that is approximately 100 days out, a little more. I think it's maybe 107, 108 days out. So we're going to look at that expiration, and I'm specifically just looking at where is the 80 delta call option. Well, with the stock at 136.76, the 80 delta call option is the 115 call. So 136.76 minus 115 means that this option has $21.76 worth of intrinsic value. It's showing me that on inside the Ally Invest platform that it has an 80 delta in this scenario. And the whole cost of the Facebook call option is on the ask price, $25.65. On the bid price is $25.40. Now, I'm mentioning the bid and ask because Facebook is an underlying stock where this is feasible to do it in. If you're doing it in less liquid stocks, I'm going to say well-known names, even like Walmart. Sometimes when you get too deep in the money, high delta option contracts, you might be paying 50 cents or 60 cents or even $1 in bid-ask spread, and it makes the strategy that we're looking at doing a lot less feasible just because of transaction costs within the bid-ask spread, liquidation costs, if you will, if you had to get out in a hurry. But in this scenario, we got fairly decent open interest. Facebook is obviously much more popular as a trading vehicle than Walmart is. So overall, we have a decent option contract to trade. We have a decent alternative. So instead of having $136 worth of risk, which I think you can fathom, I don't think Facebook is going to zero tomorrow. But did I also think that about 2 months ago when it was trading at $218 that the stock could be down almost $100, right? That happened. So I think that when that scenario happens, it wakes people up and say, hey, Brian talked about selling some shares of stock because we had a decent gain in them and using options as long options as a protection strategy. So the concept would be if I had 500 shares of Facebook, I'm going to sell the 500 shares and I'm going to buy 5 call options. So for every 100 shares that I owned, I'm going to sell it and I'm going to buy 5 call options. Now I'm truly reducing my risk from 136.76 down to, if we paid the ask price, 25.65. So 25.65, I don't quite get a one-to-one movement with the option contract, but on a $136 stock, that's only about 20% of the stock price, which we've lost way more than that if you were in this underlying stock when it hit 218, which that was the 218 was hit, the high for the year was in July 24th, July 25th, somewhere in that range. That's when it before it hit, it started to creep down lower. All right, so back in October, we saw this thing trading at 153. Then we got down as high as 151, and now we're basically at the lows of the year. The very low for the year that I have on our chart for a 1-year chart is very low is 126.85 at this point in time. So here's another alternative. We're using long options, buying options, legitly what they were intended for as an insurance product. We are taking some of the money off the table. We still get some of the upside. We're limiting our risk down to 20% on this trade, which on Facebook we've lost more of that, but we still get the upside. And here's what is the beauty of this trade is that if the underlying market continues to go on up, we will pick up deltas. So as expiration approaches, as we get to the March expiration, let's say it bounces up 20 points. Our delta should start to creep up until we're finally going 1 for 1, just like if we had owned the stock. So here's a great alternative. Instead of just bailing out of Facebook and never trading it again, give yourself a chance to get back. You still got a lot of risk, $26 on an option contract, or $25.65 to be exact. Still nothing to sneeze at, but it's much better than just being out there on this high price stock and just hoping that it continues to go straight up throughout the life of that underlying stock. So it's a tough time for the FANG stocks. I don't know where your views would be on text. I don't usually give any views because this is Options Playbook Radio, and it's only meant to be a learning tool. But we just gave you two very interesting ways to hedge Apple using a zero-cost collar. We actually got it done for a net credit going into the new year, and an alternative on a stock like Facebook where you just basically got punched in the gut as far as that underlying stock is concerned. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S, guy at invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.